Okay, so let's dive into this really fascinating and honestly pretty confusing story that's unfolding in China's tech sector. We're looking ahead to 2026, and there's this huge paradox at play. On one side, you have this massive state-driven push into AI. But on the other, you have a really baffling signal coming from global investors. Let's break it down. So get this. In 2025, some of the big China tech ETFs, like CCQQ, put up some incredible numbers. I mean, they absolutely blew past a lot of global indexes, with gains hitting as high as 44%. Now, on paper, that should be a massive flashing green light for investors, right? But here is where it gets weird. This is the paradox. Instead of piling in to chase those gains, investors were actually cashing out. They were redeeming their shares. Even as broad emerging market funds were seeing billions of dollars pour in, these top-performing China tech funds were seeing money walk right out the door. So what gives? Why on earth would winning investments be getting the cold shoulder? Answering that question takes us right to the heart of a huge, fundamental shift happening in the global tech world. And to find the answer, you've got to look way past the ticker symbols and dig into China's new national strategy. See, the reason for all this hesitation, it's not hiding in the stock charts. It's rooted in a massive pivot in China's entire economic strategy. The playbook that worked for investors just a few years ago, well, it's pretty much obsolete now. The absolute centerpiece of China's 15th five-year plan is this concept they're calling new quality productive forces. So what does that actually mean? Well, in simple terms, it's a huge state-directed pivot away from the consumer internet. You know, the apps and e-commerce giants we all know, and a massive push into the kind of deep tech that's going to power the future. We're talking AI, we're talking semiconductors, the foundational stuff. And you have to understand, this isn't just a friendly suggestion, it's a full-blown national mission. The goal here is technological self-reliance. They want to build a tech ecosystem that's basically immune to outside pressure, creating a huge internal market for their own AI chips and cloud companies, all while pouring money into R&D to close the gap with the US and Japan. And they are absolutely putting their money where their mouth is. 2.7 trillion RMB. That's how much was invested into these new strategic industries in 2024 alone. That's a jump of almost 22% from the year before, which just shows you how fast the capital is being moved around. And this chart, it just perfectly captures the scale of their ambition. The projection is for their domestic AI chip market to grow by an incredible 7 to 9 times by 2030. This isn't just regular growth. This is about creating an entirely new, massive internal market from the ground up. So, okay, if the old consumer tech giants aren't the main event anymore, how are investors supposed to get exposure to this new state-driven tech ecosystem? Well, the answer seems to lie in a different market, with a whole different set of tools. So where's the action shifting? Increasingly, it's all about the Hong Kong Stock Exchange. It's really become the global hub for these new, specialized funds that let investors be much more targeted than the big, broad ETFs you might find listed in the US. And this is where it gets really interesting for investors. Instead of a one-size-fits-all approach, you can now get surgical. You can still buy into the broad tech giants with something like ETF 3033, or you can zero in on the robotics revolution with 2807. You can even invest in the unseen backbone, all the data centers, with 3401. Heck, you can even get a mix of Chinese and US tech giants with 3442. The toolkit is just so much more specialized now. All right, but let's be real. None of this is happening in a bubble. This entire investment story is playing out against a backdrop of some serious two-way risks. And that goes a long way toward explaining that investor hesitation we talked about right at the start. What we're really seeing is this high-stakes strategic battle of choke points. On one side, you have the US using what it calls a managed restriction framework, which basically caps the level of chip technology that can operate inside China. On the other side, China is leveraging its huge control over critical minerals, things like tungsten and silver that are essential for robotics, creating its own set of choke points for the global supply chain. And the pressure isn't just coming from the outside. Domestically, China has put some serious guardrails in place by formally including AI governance in its cybersecurity law. For investors, this is kind of a double-edged sword. On one hand, it creates a more predictable rulebook. But on the other, it also creates a much more supervised environment with really strict data laws and some pretty steep fines for any missteps. So we've got the new strategy, we've got the risks. So where is the real opportunity that has analysts so focused? It all seems to be building towards this next wave. physical AI. This is where the strategy starts to become tangible, something you can see and touch. The big story for the back half of this decade is the shift from AI that only exists as software to AI in intelligent physical machines. The key phrase here is embodied intelligence. It's just a way of saying you're merging AI brains with robotic bodies, and it's seen as the next massive growth driver. And this isn't science fiction, it's already happening. This technology is pretty mature in industrial settings, like car factories and huge logistics warehouses. But the real growth frontier, the explosion that's coming, is in these emerging sectors, like healthcare and services. That's where it's going next. And the growth that's projected here is just staggering. We're talking about a market for this physical AI that could hit 1.55 trillion RMB by 2030. This isn't just a small evolution, it's a fundamental shift from a market focused on software to one that can fully leverage China's massive world-class manufacturing power. So let's bring all this home. What's the big takeaway from all of this? How are professional investors actually trying to navigate this new, really complex landscape as they look at 2026 and beyond? Okay, the most important thing to get is that the old way of doing things is dead. Just buying a broad passive index fund and setting it and forgetting it, that playbook is obsolete. What's replacing it is a much more tactical, phased approach designed to build a portfolio that's fragmentation ready for a tech world that no longer moves in lockstep. So here's the game plan that's emerging. It's a clear progression. You start in the first half of 2026 by building a foundational core position in broad tech. Then, as the year goes on, you start to rotate into the infrastructure, the hardware, the data centers that's needed to power all this AI. And finally, you pivot towards the end of the year and beyond, targeting those specialized robotics and physical AI funds, just as that sector really starts to commercialize and hit scale. And that really leaves us with a final, massive question for the future of investing. As the global tech world continues to split and fragment, is the era of just buying the market over? In this new environment, it looks like success might depend a lot less on just having broad access and a whole lot more on having a deep, specialized understanding of these powerful, emerging, and state-driven ecosystems.